Disclaimer.
Today is January 15th, 2026, and the financial world has just crossed the point of no return. If you looked at the charts this morning, you saw a massacre. Silver was violently slammed from $92 down to $87.59 in just a few minutes last night. But make no mistake, this isn't a market collapse, it's a desperate surgical intervention. At 10:40 p.m. last night, during the most illiquid window of global trading, someone dumped 10 million ounces of paper silver onto the COMEX. Why? Because the physical system is breaking, and they are trying to break the thermometer before the mercury explodes. Walk into any coin shop in America right now and ask for a 100-ounce silver bar. The dealer will quote you something north of $100 per ounce, maybe more if they even have inventory. Then pull up your phone and check the COMEX silver price, the number every financial website displays as the official market rate. It shows $89. You're staring at two prices for the same metal, separated by a gap that shouldn't exist in functioning markets. This isn't a small discrepancy we're talking about. According to data from the Shanghai Gold Exchange, physical silver traded hands at $100.59 per ounce on January 13th, while COMEX futures contracts showed $89. That's a 12 to 13% premium for the actual metal over the paper promise. Think about what that means for a moment. If you wanted to buy shares of Apple stock, you wouldn't pay 12% more than the listed price just because you insisted on receiving an actual stock certificate instead of a digital entry. But that's exactly what's happening in silver markets right now, and the gap keeps widening. Here's where it gets interesting. On January 1st of this year, China quietly implemented new strategic export controls on silver. The announcement barely made headlines in Western financial media, but the implications hit global supply chains like a freight train. China isn't just any player in silver markets. They're the world's fourth largest producer and a massive refining hub for metal coming from mines across Asia and Latin America. When Chinese customs officials started turning back silver export applications, physical dealers from Tokyo to Dubai suddenly found their usual supply channels severed. The Shanghai Premium tells you everything you need to know about what happens when paper markets collide with physical reality. Chinese buyers are paying over $100 per ounce because they can't get metal anywhere else, while American traders are still buying and selling contracts at $89 based on the assumption that physical delivery will happen smoothly when needed. One of these prices reflects the actual cost of obtaining metal you can hold in your hand. The other reflects a system built on the assumption that most traders will settle in cash rather than demanding actual delivery. Now let's talk about what's happening in markets where the Chinese export ban hit hardest. Dealers in Japan reported physical silver trading at $130 per ounce when they could even source material according to precious metals, trade publications monitoring Asian markets in mid-January. That's an 80% premium over the COMEX paper price. In the United Arab Emirates, similar dynamics emerged as Middle Eastern buyers scrambled to secure physical metal before available supplies vanished entirely. These aren't isolated incidents or temporary dislocations. This is systematic decoupling between paper derivatives and physical commodities. You've probably noticed that financial markets usually correct these kinds of arbitrage opportunities within hours or days. If silver genuinely trades at $100 in Shanghai and $89 in New York, someone should be buying COMEX contracts, taking delivery, shipping the metal to China, and pocketing the difference. The fact that this spread persists and widens tells you the arbitrage doesn't work anymore. Either you can't get physical metal from COMEX at the stated price, or you can't export it to where premiums exist, or both constraints are binding simultaneously. Let me put this in perspective with something closer to home. Imagine you're planning a vacation and you check online prices for hotel rooms in Miami. Every website shows $200 per night for beachfront properties. You call the hotels directly and they tell you rooms actually cost $350, but the online booking engines haven't updated yet. Would you trust those online prices? Would you base your vacation budget on numbers that don't reflect reality? That's essentially what's happening with silver right now, except the stakes involve trillions of dollars in derivatives, contracts, and the functioning of global commodity markets. The World Gold Council, which also tracks silver market dynamics despite its name, noted in their January report that physical delivery requests have surged across all precious metals since late 2025. But silver shows the most extreme divergence between futures prices and physical availability. When you factor in refining, shipping, and dealer margins, the typical premium for physical silver over paper prices runs about 4 to 6% in normal markets. We're currently seeing premiums 2 to 3 times that level in the most liquid markets on Earth. Here's what should grab our attention. This decoupling isn't happening because of some temporary logistics problem or seasonal demand spike. The Chinese export ban created a structural break in global silver supply chains. Western markets consume far more silver than our mines produce, relying on imports and recycling to meet industrial and investment demand. When one of the world's major supply arteries gets cut off, the physical market reprices immediately while paper markets continue operating as if nothing changed. Pop quiz: what happens when paper contracts come due for delivery and the metal is unavailable at anywhere near the futures price? The traders who sold those contracts face a stark choice. They can default on delivery obligations, which would expose the entire derivative system as built on sand, or they can pay whatever premium the physical market demands, potentially bankrupting themselves in the process. Neither option ends well for the current market structure. According to Bank for International Settlements data on commodity derivatives, silver futures open interest remains near record highs, even as physical inventories decline. That means the gap between paper claims on silver and actual available metal keeps expanding. Every new contract written increases the total claims on a finite physical supply. Eventually, someone gets left holding a worthless paper promise when the music stops. The truly unprecedented aspect of our current situation isn't just the size of the premium. It's the speed at which this decoupling emerged and the complete inability of arbitrage to close the gap. Under normal market conditions, price differences between Shanghai and New York get exploited away within trading sessions. We're now multiple weeks into premiums exceeding 10% with no sign of convergence. That tells you the fundamental mechanics of price discovery have broken down. Think about your own investment portfolio for a moment. If you own silver through an exchange-traded fund or a futures contract, you're holding a claim on metal at the COMEX price. But if you ever needed to convert that claim into actual physical silver, you could store in a safe. You'd pay the physical premium. That gap represents either an enormous profit opportunity or an enormous risk, depending on which side of the trade you're on. And right now, the people holding paper promises are slowly realizing they might be on the wrong side of history's largest commodity squeeze. This is the great decoupling. Two prices for one metal. One reflects the cost of obtaining something real. The other reflects the cost of trading paper promises in a system built on the assumption that physical delivery rarely happens. And in January of 2026, that assumption started crumbling in real time. Something unprecedented is happening in the silver market, and it signals a level of panic we haven't seen before. Traders are now paying a premium, a significant one, just to get their hands on physical silver a little bit sooner. This phenomenon is called backward rolling, and it's a huge red flag that the market is fearing a genuine physical silver shortage. Let me break down how this is supposed to work. In a normal, healthy futures market, you have what's called a contango structure. Imagine you're a trader. You can either buy a contract for silver to be delivered next month, or you can buy one for delivery, say, 3 months from now. Typically, the contract for 3 months out is more expensive. Why? Because it costs money to store and insure that silver for the extra 2 months. This price difference is the carry cost, and it is the financial incentive for someone to hold onto the physical metal and deliver it to you later. It's a stable, predictable system. What we're seeing now is the complete opposite of that. We're now in a state of backwardation, and it's not just any backwardation, it's what some are calling super backwardation. The contract for silver delivery. Next month is now more expensive than the one for delivery in a few months. Think about that. The market is so desperate for immediate physical silver that traders are willing to pay a premium to jump the queue. They're basically saying, I don't trust that the silver will be there in a few months, so I need it now, and I'll pay extra for it. This isn't just a small fluctuation. We're talking about traders paying an additional 25 cents per ounce to roll their July contracts forward into the more immediate May contracts. They are actively paying money to get their silver just 2 months earlier. This is not normal. It's a sign of a market under extreme stress, a market where the participants believe there's not enough physical silver to go around to meet all the contractual obligations. It's a scramble for a very finite supply. Now, let's talk about one of the biggest players in this game, JP Morgan. For years, JP Morgan was notorious in the silver market, often accused of manipulating prices downwards with massive short positions. They were seen as the big bully keeping the price of silver suppressed. But recently, their behavior has done a complete 180. They've closed out their massive short positions and have become one of the most aggressive buyers of physical silver. They've been taking delivery of huge quantities of silver from the COMEX exchange, effectively draining its inventory. This move is incredibly significant. When the most informed, most powerful player in the market, a bank that once allegedly benefited from lower prices, suddenly starts hoarding physical silver like there's no tomorrow, you have to ask why. They have access to information and analysis that most of us can only dream of. Their actions suggest they see a major supply crunch on the horizon and are positioning themselves to be on the right side of it. They are no longer betting on paper contracts. They are accumulating the real physical asset. It's a classic case of do as they do, not as they say. And what they are doing is stockpiling silver. The situation has become so critical that the exchange itself, the CME group which operates the COMEX, has had to step in with emergency measures. This is where it gets really serious The CME has a rule, Rule 589, which is basically an emergency button they can press when market integrity is at risk. And they just pressed it. They have effectively granted themselves the power to force traders to settle their contracts in cash instead of physical silver. Let that sink in. The whole point of a futures contract for a physical commodity is the promise that you can, if you choose, take delivery of the actual thing, the silver bars. But now the exchange is saying we might not be able to guarantee that. We might just give you cash instead. This is an admission that they fear a run on their inventory, a situation where so many traders demand physical delivery that the vaults run empty. This is called a force majeure situation, and it fundamentally breaks the promise of the market. It turns a physicals-backed market into a purely cash-settled casino where the paper price can completely detach from the price of real physical silver. What does this mean for the price? Well, if they can just print money and pay off contracts instead of delivering silver, it could artificially suppress the paper price shown on your screen. But in the real world, the price for physical silver, the coins and bars you can actually hold, could skyrocket. We are witnessing a divergence between the paper market and the physical market. The paper price is what they want you to see. The physical price is what it actually costs to get your hands on the metal. This cash settlement option is the ultimate safety valve for the exchange, but it's a disaster for anyone who thought their contract was a secure claim on physical metal. It's like having a ticket for a sold-out concert, but when you get to the door, they just hand you your money back and say, "Sorry, the venue is full." The value wasn't the ticket, it was the access to the event. The value of a silver contract isn't the paper, it's the claim on the silver. So let's put all the pieces together. We have traders in a panic, paying extra to get silver now because they fear it won't be there later. That's the backward roll. We have the biggest player in the market, JP Morgan, switching from being a seller to a massive hoarder of physical silver. And now we have the exchange itself changing the rules mid-game, preparing for the possibility that they can't deliver on their promises. This isn't just some technical market anomaly that only a few traders care about. This is the foundation of the global commodity pricing structure, showing cracks in real time. The trust that underpins the entire system is eroding before our eyes. When you can no longer exchange your paper claim for the physical asset, the paper claim becomes worthless. We are on the verge of a major repricing event for physical silver, one that could see it completely decouple from the manipulated paper prices we've been seeing for years. The game is changing and the scramble for physical metal has already begun. The signs are everywhere, for those who are willing to look. The market is telling us that a severe shortage is not just a possibility, it may already be here. This is a story that is unfolding right now, and its implications could be felt far beyond the world of commodities. Thanks for watching, and if you found this breakdown helpful, be sure to subscribe for more updates. Before we dive into what happens next, I want to thank you for watching and being part of this community. If this analysis is helping you understand what's really happening in silver markets, please hit that like button, drop a comment with your thoughts, and subscribe so you don't miss future updates on these critical financial developments. Your engagement helps this message reach more people who need to understand what's coming. Now, remember that overnight price slam we started with? Silver dropping from $92 to $87.59 in minutes during the most illiquid trading window? Let me tell you what really triggered that coordinated sell-off and why it actually proves the system is days from breaking rather than recovering. On January 14th, President Trump announced a delay in implementing new tariffs. Financial algorithms interpreted this as deflationary and, within seconds, dumped massive short positions across precious metals. 10 million ounces of paper silver hit COMEX order books. The price cratered, headlines screamed collapse, and casual observers assumed the rally was over. But here's what those algorithms missed. While paper silver plunged overnight, the Shanghai physical premium barely budged. On January 15th, even after COMEX showed $89, Chinese dealers were still paying over $100 for deliverable metal. The gap actually widened during the sell-off. If this were genuine market correction, both prices would have moved together. Instead, the paper price crashed while a physical premium held firm, proving these are two completely separate markets now. By midday, trading on January 15th, silver recovered most overnight losses, climbing back above $90. A 10 million ounce sell order that would normally take days to absorb got bought up in hours. That buying came from the same traders rolling contracts backward, the same institutions demanding physical delivery, the same market participants who understand that $87 for silver is an opportunity if you can actually get deliverable metal at that price. According to COMEX inventory reports, registered silver has fallen from over 200 million ounces in 2020 to just 60 million ounces today, a 70% decline while open interest remained elevated. Now add those backward rolled contracts, 3,000 contracts worth 15 million ounces demanding delivery in January and February. That's a quarter of total registered inventory claimed by those backward rolls alone. Here's where the math becomes unavoidable. If even 10% of current open interest stands for delivery over the next 2 months, registered inventories can't satisfy those claims at any price close to $90. The exchange faces a choice between defaulting on contracts or allowing prices to spike to whatever level brings physical metal out of private storage. Neither option maintains the current market structure. Now let me explain backwardation and why it's absolutely critical to understanding what's happening. In normal commodity markets, futures prices increase as you look further into the future. This structure is called contango. If you buy wheat for delivery in 6 months instead of today, you're paying for storage, insurance, and financing costs. The distant contract should cost more. Backwardation flips this completely upside down. Spot prices, what you pay for immediate delivery, are higher than futures prices for delivery months from now. Silver futures have been in backwardation since early January, and it's deepening. Traders are literally paying more to get silver today than to get it in March or May. They're accepting a guaranteed loss on the time value of money just to possess physical metal immediately. This only happens when physical shortage becomes acute. The market doesn't trust that metal will be available later, or believes premiums will explode even higher, or fears the entire delivery system might fail before distant contracts mature. Backwardation is the commodity market equivalent of a bank run. Everyone wants their metal now because they don't believe promises about future delivery. Let me give you the critical timeline everyone needs to watch. Those backward rolled contracts demanding January and February delivery start maturing at the end of this month. First notice, day for January, contracts falls on January 29th. That's when traders holding long positions must notify the exchange whether they intend to take physical delivery or roll forward. Between January 29th and February 10th, 15 million ounces worth of accelerated delivery demands hit a system with only 60 million ounces of registered inventory. But those aren't the only claims. Regular February contract holders also have delivery rights. Industrial manufacturers need physical silver for production, and institutions like JP Morgan are standing for delivery regardless of cost. Let's do the math. 15 million ounces from backward rolls. Conservatively, another 10 million from regular February deliveries, another 5 million from industrial demand. You're looking at 30 million ounces of delivery claims within a 2-week window against 60 million ounces of registered inventory. And registered inventory isn't sitting ready to be handed over. Much is tied up in financing arrangements, hypothecated multiple times, or spoken for by previous assignments. February 10th is the last trading day for February contracts. By that date, every long position must either take delivery or settle in cash. If the registered inventory can't satisfy claims, the exchange faces its moment of truth. This is when we find out whether the paper price system survives or collapses under the weight of physical reality. Now let me walk you through the 3 possible outcomes and what each means. First option. The exchange continues raising margins, changing delivery rules, and applying regulatory pressure to force cash settlement instead of physical delivery. They could limit delivery contracts per entity, extend settlement windows, or change terms mid-game to protect the system. But every rule change that makes physical delivery harder confirms that paper claims are not backed by real metal. It destroys the foundational premise of futures markets, that a contract represents a genuine right to receive the underlying commodity. Once that confidence breaks, the futures market loses its primary function. Industrial users stop hedging there. Investors stop trusting it. The death spiral accelerates. Second option. The exchange allows prices to spike to whatever level brings more metal into registered inventory from private storage. Let silver trade to $120, $150, $200 if that's what it takes to satisfy delivery demands. This maintains the exchange's credibility but validates that the Shanghai premium was the real price all along. It also bankrupts every institution that sold silver short assuming cash settlement. Third option. The exchange declares force majeure and defaults on delivery obligations, offering cash settlement at some predetermined price, regardless of what physical silver actually trades for. This is the nuclear option that would effectively end the COMEX as a credible commodity exchange. Why would anyone trust a futures market that defaults when things get difficult? None of these 3 outcomes preserves the current system where paper prices and physical premiums coexist in comfortable separation. One path destroys market credibility through rule changes. Another validates the premium through price spikes. The third destroys everything through default. The only question is which path the exchange chooses when February delivery pressure peaks. Now think about your own position. If you hold silver through exchange-traded funds or futures contracts, you own a claim priced at paper rate. If that fund needed to convert all claims into deliverable metal tomorrow, it would face the same backward squeeze. The difference between your account statement and what you could obtain in physical form is that 12 to 13% Shanghai premium. If you hold physical coins or bars in a safe or allocated storage, you own an asset trading at substantial premiums in real markets. Your physical metal is worth what someone will actually pay you for it in the real world, not what a futures contract settles at on a screen. The gap represents the greatest wealth transfer in modern commodity markets. Paper holders face counterparty risk. Physical holders already possess the asset. As delivery pressure intensifies through February, that gap will either close through paper prices spiking upward or widen catastrophically if the exchange defaults. The overnight price slam didn't change any fundamental dynamics we've discussed. Registered inventories didn't increase. The Shanghai premium didn't collapse. Backward contract rolling didn't reverse. JP Morgan didn't stop demanding delivery. Banks didn't start accepting silver as collateral again. Backwardation didn't disappear. All that changed was the paper price that algorithms obsess over while ignoring physical reality underneath. This is the $89 illusion. It's the number displayed on screens. But it's not the price you pay to walk into a dealer and walk out with silver. It's not the price Chinese buyers pay in Shanghai. It's not even the effective price backward-rolling traders pay when you factor in acceleration premiums. We're watching the final act of a 50-year experiment in paper commodity markets, built on the assumption that physical backing did not matter as long as everyone believed it did. Those assumptions are breaking down in real time, and the calendar is racing toward late January and early February, when thousands of accelerated delivery demands will test whether 60 million ounces can satisfy claims that probably exceed it several times over. You now understand what most market participants are still missing. The overnight price slam wasn't a market correction. It was algorithm-driven paper selling. The recovery within hours proved real buying demand is absorbing every dip. The Shanghai premium, holding above $100, proved physical markets have already repriced reality. The system isn't recovering. It's counting down to delivery day. When those backward-rolled contracts mature at the end of January, we'll find out whether the COMEX can deliver 15 million ounces to traders who paid premiums to jump to the front of the line. This is where we are on January 15th, 2026. The great decoupling between paper and physical, the backward squeeze showing unprecedented delivery urgency, and the $89 illusion masking a physical market that's already broken free. So here's what you need to do right now. First, understand exactly what you own. If you hold silver through ETFs or retirement accounts, call your broker tomorrow morning and ask them to explain how your fund would handle physical delivery requests if 10% of shareholders demanded actual metal. Ask them where the silver is stored. Ask them if it's allocated or unallocated. Their answers will tell you everything about your counterparty risk. Second, verify this information yourself. Don't take my word for it. Go to the CME Group website and check registered silver inventory numbers. Compare COMEX futures prices to Shanghai Gold Exchange physical premiums. Look at the backward contract rolling data. The evidence is sitting in public databases waiting for you to confirm it. When you see it with your own eyes, the reality becomes undeniable. Third, mark your calendar. January 29th is first notice day. February 10th is last trading day for February contracts. Between those dates, we'll see whether the futures market can satisfy delivery demands or whether the system breaks. Watch what happens to registered inventory. Watch what happens to premiums. Watch whether the exchange changes rules mid-game to avoid delivery obligations. These 2 weeks will answer every question we've discussed today. Fourth, and this is critical, share this information. Right now, most investors have no idea there are two different silver prices operating simultaneously. They see $89 on their screens and assume that's reality. They don't know about Shanghai premiums, backward rolling, or the inventory crisis building toward February. Send this video to anyone you know who owns silver in any form. They need to understand the difference between paper claims and physical possession before it's too late. If you found this analysis valuable, hit that subscribe button and turn on notifications. Over the next few weeks, I'll be tracking every development as this situation unfolds. Every rule change the exchange makes, every shift in registered inventory, every movement in physical premiums. You need to stay informed as this countdown continues, and I'll be here breaking down what it all means in real time. Drop a comment below and tell me, are you holding paper or physical silver right now? And after watching this, do you understand your exposure differently? I want to hear your perspective, and I read every single comment. This community is built on sharing real information that mainstream financial media won't touch. The question isn't whether the paper system can maintain the illusion much longer. The mathematics of delivery pressure against available inventory answer that clearly. The real question is whether you're going to be one of the people who understood what was happening before it became obvious to everyone else. Whether you're going to verify this information, understand your own position, and make informed decisions based on reality instead of illusions. The countdown has started, the delivery demands are coming, and our financial system is about to discover whether promises on paper can satisfy claims for something real. You now have the information, you know the timeline, you understand the mechanics. What you do with that knowledge is up to you. Stay informed, stay alert. And I'll see you in the next update as this historic squeeze continues to unfold.